You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome, curious minds, to another deep dive.
Great to be here.
Today, we're really plunging into a rich mix of global insights. We're pulling from the latest market briefings.
Yeah, currencies, commodities, trade.
Exactly. And even a pretty fascinating bit of quiet geopolitics.
Mm-hmm.
Our mission, like always, is to, cut through that daily noise, grab those vital nuggets of knowledge, and really connect the dots so you can walk away feeling truly well-informed about what's shaping our world.
Precisely. We're not just looking at the what. We want to dig into the why behind these global shifts. And more importantly, maybe explore those implications that link things you wouldn't normally connect.
Yeah.
You'll hopefully gain a clearer understanding of how these forces are intertwined. Maybe have some aha moments.
I like the sound of that. Okay, let's unpack this then. We've got central banks making these very nuanced moves.
Tricky stuff.
Major players hinting at shifting trade dynamics, the building blocks of the economy, commodities. They're fluctuating.
Yeah, in some unexpected ways.
And even that quiet, but I think significant diplomatic chat on the geopolitical front.
Absolutely.
It's a lot, but we're going to guide you through it.
Sure.
Let's kick things off with currencies. Always fascinating. Starting with the U.S. dollar, it's given back some recent gains after the Fed's 25 basis point rate cut. Now, usually a rate cut weakens a currency, right? But here's where it gets, really interesting. Chair Powell's press conference, it leaned pretty hawkish.
Definitely.
He framed it as a risk management cut, not the start of some easing cycle. What signal are they trying to send? Is it even working?
Well, that's the crux of it, isn't it? A hawkish cut. It's kind of a rare beast. It means the Fed's cutting rates, that 25 basis points is, 0.25%, but not because they see trouble right now.
Okay.
It's more like they're managing specific, maybe undefined risks to the outlook proactively.
Risk management.
Exactly. And Powell stressing no rush to ease further, policy staying data dependent. That's a clear signal. They're basically saying, don't assume this is the first of many cuts. They're managing expectations hard.
Right. Trying to keep those market bets in check.
Precisely. And the dollar's mixed performance. It shows traders are sort of wrestling with this message. Is it a one-off, or will the market push for more anyway?
So, okay, the dollar's playing this subtle game. What about other major currencies then? The euro, for instance, it's edging higher.
Mm-hmm.
Is that just relief against a slightly softer dollar, or is there something more going on with the ECB?
It's probably both, but with an important twist, I think. Yes, the euro definitely gets a lift from that weaker dollar tone. But what's really striking are the comments from ECB Vice President Guindos.
Okay, what did he say?
He stressed that inflation risks are balanced, fair enough, but crucially that the ECB needs to watch the exchange rate broadly.
Broadly, not just against the dollar.
Exactly, not just the dollar. That broader perspective is a real signal. It suggests the ECB knows inflation isn't just a U.S.-Euro thing anymore. It's coming from multiple directions.
Like Asia, commodity prices.
Precisely. They're likely looking at the impact of Asian currencies, global commodity prices on imported inflation. It signals a more complex fight for price stability. It's a recognition that global pressures can hit from anywhere now.
That is fascinating. Okay, so the euro's finding some strength. Let's pivot to sterling. It slipped back below 1.37. That's under $1.37 to the pound.
Yeah.
And all eyes are on today's Bank of England decision. What's the feeling there? What are people expecting?
Well, the market widely expects the buoy to hold rates steady at 4.0%. That seems pretty baked in.
Okay, hold steady.
But the key detail, maybe the bigger story really, is the expected slowing of quantitative tightening. QT.
Right, QT. They're shrinking their balance sheet.
Exactly. By letting bonds mature without reinvesting, they're expected to slow that down from about $100 billion a year to maybe $70 billion down.
So still tightening, but less aggressively.
Yes. It means they're still pulling money out of the system, but they're easing off the brakes a bit. It's a softer approach to withdrawing that stimulus. It can help support bond yields, market stability.
But couldn't slowing QT, even slightly, signals some underlying economic weakness, not just a technical tweak.
Absolutely. That's the tightrope they're walking. On one hand, yeah, it's a technical adjustment for market functioning, but on the other, it can accidentally signal caution, about the economy's ability to handle aggressive tightening.
Right. Makes investors wonder if the UK economy is more sensitive than thought.
Exactly. It just highlights the delicate balancing act all central banks are facing now, often with these conflicting signals.
Speaking of conflicting signals, the Nordics. Norges Bank cut rates 25 basis points, but then issued a hawkish report. That limited the downside for the krone.
Yeah, another hawkish cut. They cut, but immediately tried to manage expectations, signal they're still fighting inflation, trying to keep the krone stable.
And then there's the Kiwi dollar. Under pressure after that GDP contraction, 0.6% year-on-year. That's pretty stark.
It really is stark, clearly recessionary. And it's forced the market's hand. Markets are now fully pricing in an October rate cut from the RBNZ. Some are even talking about a 50 basis point move.
Wow, 50 points.
It shows a central bank reacting to really undeniable economic weakness, unlike Norway's proactive move.
So these examples really show the divergent paths central banks are taking.
Absolutely. Norges Bank is proactive. The RBNZ is reactive. It shows how different economies face different pressures. No unified global policy is possible right now.
So for you, the listener, really understanding these moves, it helps make sense of global economic health. It's not just what they do, but how they say it and what the data is really telling them.
The communication is key.
Right. Let's pivot now. Trade and tariffs, always complex. We're seeing some interesting developments, particularly U.S.-China. Beijing has reportedly dropped its antitrust probe into Google. That sounds significant. An olive branch? Or something?
It certainly feels like an olive branch, doesn't it? Dropping that Google probe. In the context of these ongoing, often quite tense U.S.-China talks, yeah, it could signal a desire to de-escalate.
Okay.
But the real insight, I think, is to ask what Beijing might expect in return.
Ah, right. It's never just a gift.
Exactly. It's a strategic chess move, maybe aimed at building a bit of trust, creating a better atmosphere for talks. But they're likely hoping for something back, maybe on tech access, maybe less scrutiny on their own companies.
And then there's TikTok. Always TikTok.
Oh, wait.
China's Commerce Ministry says it will review tech and IP transfer approvals for TikTok. Yeah. Meanwhile, U.S. House lawmakers are voicing concerns about any potential deal structure. So Google detente, maybe, but TikTok's still right in the thick of it.
And this brings up a crucial point, right? These negotiations are complex, multifaceted. China reviewing the tech transfers. That confirms TikTok is still a key point of negotiation. It highlights the deep national security tech control aspects. It's about data, influence.
Not just economics.
Not just economics at all. And the concerns from U.S. lawmakers. That keeps political risk on the table. Even if a deal is struck between companies, it might face huge hurdles back in Washington. Data security, foreign influence worries.
So it's this delicate balance: economic interest, national security, domestic politics.
A very delicate balance. Any resolution will be a hard one, compromise, I suspect.
Okay, shifting continents. South America.
Yeah.
Brazil's President Lula has been vocal, criticizing U.S. tariffs, calling them politically motivated, warning about higher costs for U.S. consumers.
Yeah, that's a direct challenge to the whole premise of protectionism, isn't it? Lula's basically saying these tariffs harm your own consumers more than they protect industry, framing it as politics, not sound economics.
Saying you're just making life expensive for your own people.
Pretty much. And it's interesting, while he's criticizing U.S. policy, he also signed a decree exempting some data center gear from federal tax in Brazil.
Oh, interesting. So promoting tech investment at home.
Yeah, exactly. It shows that domestic policy choices can be used to attract investment, even while you're arguing against protectionism elsewhere. It's nuanced. Protect your own growth, but call out others' policies if you think they're counterproductive.
And these trade decisions, they really do affect the cost of goods you buy, the companies you deal with. It shows how global politics trickles right down.
It's not abstract policy. It hits your wallet.
Absolutely. Okay, let's dive into commodities. The raw materials fueling everything. Crude oil, it remains subdued, kind of stuck in a tight range.
Yeah, surprisingly so.
Despite generally supportive risk sentiment elsewhere, that feels contradictory. Shouldn't positive sentiment lift oil?
It absolutely feels contradictory, and that's the real insight, I think. Supportive risk sentiment usually means higher demand expectations, potentially higher prices, but oil isn't really playing ball.
So what's going on?
It suggests other factors are at play. Maybe ample supply is just meeting demand consistently.
Yes.
Or maybe there are lingering demand concerns from specific big consumers, like in industry, despite the redder mood. We're also seeing some subtle supply signals. Qatar raising its November price for Al-Shaheen crude suggests they're confident in demand for their specific type. Meanwhile, Russia's finance ministry plans to gradually lower its budget's oil price cutoff through 2030.
Lowering the cutoff.
They'll need oil prices to be higher in the future for their budget to balance. That could influence their production decisions down the line, might tighten their fiscal stance. It's a whole dance between supply management and underlying demand.
Okay, moving to shiny things. Precious metals. Gold has recovered from early losses, supported by that softer dollar in Europe, holding near the top of its recent range, around $3,670.
Yeah, this really highlights gold's classic role, doesn't it? Safe haven, inverse relationship with the dollar. A softer dollar makes gold cheaper for international buyers, boosts appeal.
Right.
And the fact it's holding near that upper end suggests there's solid underlying demand, a continued hedge against uncertainty, even if risk sentiment looks okay on the surface.
Like a quiet protest against perceived stability.
Something like that. A persistent underlying caution.
And base metals. Copper, for example,
Yeah.
still under pressure. It slipped back below $10,000 a ton, even though sentiment in Europe seemed firmer. That feels like a key divergence.
It really does. If Europe's feeling better, why isn't Dr. Copper telling a happier story?
Exactly.
And that's precisely the insight we should grab here. Copper's the bellwether, right? Used everywhere. Construction, electronics, manufacturing. It's dipped below $10 K. Even with firmer European sentiment, it raises big questions about global industrial demand.
Especially from places like China.
Particularly from major consumers like China, or it suggests maybe specific manufacturing sectors are still struggling. It could be signaling a more uneven global industrial recovery than the headline suggests. Maybe services in Europe are okay, but heavy industry, the real copper engine, is sputtering elsewhere.
A lopsided recovery indicator.
A potentially stark indicator, yes.
These commodity prices, they really are foundational, impacting everything from your energy bill to construction costs. Ultimately, your wallet.
They're the raw data of economic activity.
Okay, finally, let's wrap up with that fascinating geopolitical bit. Syrian President al-Shara's comments on security talks with Israel.
Yeah, quite something.
He said these talks could yield results soon, maybe lead to more agreements. Given the history, that's significant.
It is significant, but what's really striking is the detail he included.
Which was?
That normalization of relations is not currently under discussion.
Okay. So not a peace treaty.
Not a broad peace treaty, no full diplomatic embrace. These are focused security talks, addressing specific, practical issues.
And he stressed no external pressure from Washington.
Crucially, yes. No external pressure from Washington on Damascus to finalize a deal, which suggests the motivation is likely internal, coming from both sides.
That is a critical point. If normalization's off the table and there's no big breaker pushing them, what are the real drivers for these talks now?
Good question.
What specific security concerns make these longtime adversaries talk directly? And what could these additional agreements look like without full recognition?
Well, that's where the deep dive comes in, isn't it? The drivers are probably complex. Could be managing shared threats, maybe regional instability from non-state groups.
Right.
Or coordinating on border security to stop accidental escalations. Practical stuff. These additional agreements, they could be very functional. De-escalation hotlines, maybe intelligence sharing on specific mutual threats, even coordinating on humanitarian issues near the border.
So very practical, security-focused.
Exactly. It signals a willingness by both sides to tackle concrete security challenges directly, probably driven by their own internal calculations for stability, not grand diplomatic aims.
It's quiet, pragmatic diplomacy.
Focused on managing risks in a really complex neighborhood without needing to declare friendship first.
And that subtle shift, former enemies talking directly on security, it's a significant evolution for regional autonomy, maybe.
It could well be. Suggests a new kind of pragmatism might be taking hold.
And this quiet, focused diplomacy, even without full normalization, yeah, it could have profound effects on regional stability, even if it doesn't grab headlines.
Finding common ground on critical security when politics is still too hard.
What a journey we've been on. From those intricate central bank moves, hawkish cuts, nuanced QT, through the strategic trade talks, commodities signaling lopsided recovery.
Yeah.
And even these quiet, pragmatic, diplomatic steps between old adversaries. We've unpacked a lot.
We certainly have. And these aren't isolated events, are they? They're all threads in this constantly evolving global tapestry. Understanding how they interplay lets you see that bigger picture, maybe assess the news you see every day a bit more critically.
Right, recognizing the subtle signals.
And understanding the complex motivations behind what global players are doing.
So thinking about all this for you, the listener, what does it all mean? You've got these mixed signals from central banks, cautious cuts here, reactions to stark data there. You've got strategic trade moves, but with political risk still very much alive. And this quiet diplomacy focused on security, not normalization. How do you see these powerful, sometimes contradictory forces shaping things in the coming months? Are we heading for cautious easing? Or do these divergences mean more volatility, more unforeseen challenges? It's definitely a lot to mull over.
It really is. And we'd encourage you to keep connecting those dots. Keep questioning the assumptions behind the headlines. The more you understand these deeper currents, the better equipped you'll be to navigate this complex world.
Anticipate trends, not just react.
Exactly. Be prepared.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.